People, got too excited about gold in the early days of the pandemic. And so it was due for a correction. But now gold is dramatically undervalued relative to real interest rates. And I'm just talking about the 30-year yield less core CPI. That relationship suggests gold prices should be much higher than they are today. So that situation has fundamentally shifted.
This week's special with Miles Franklin Precious Metal Investments. Kilo Valcambi silver bars for only $2.75 over spot. 10-ounce Nadir silver bars for only $2.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson, and with us today is Jesse Felder from the Felder Report. Jesse, thank you so much for joining us today.
Good to be with you, Elijah.
All right. Now, today we're seeing quite a pullback in all the stock indices right now. Year to date, for the Dow, we're down 8%, 11% for the S&P, and 15% for the NASDAQ. Why do you think we're seeing such a pullback this year and today specifically?
Well, to me, the biggest factor to pay attention to is the Fed. We had the Fed print about $5 trillion in just under 2-year time frame. And as long as central banking has been around, central bankers have understood their ability to stoke animal spirits in the markets, print a bunch of money and literally pump it right into the treasury market. And that's going to stoke animal spirits, essentially get investors to take on a ton more risk than they otherwise would. And that's exactly what we saw, right? We saw, like I said, $5 trillion of money being printed and literally pumped directly into the markets, technically into treasuries and mortgage-backed securities. But that stoked animal spirits to a way that I've probably never seen in my career. I think it was bigger than what we saw in the dot-com mania. Investors chasing risk in any shape or form that they could find, and via very leveraged instruments like not just margin debt and futures, but we saw call options scream. Just the volume of call option buying we saw was something we've never even seen before, not even close. And so now that the Fed is in a position to where they're saying, okay, we have to undo this monetary stimulus. Not only do we have to raise interest rates, we probably have to stop bond purchases and potentially even start shrinking the balance sheet, essentially going from printing money to net liquidity withdrawals from the market. And so I think what we're seeing is, my friend Adam Taggart said, they printed so much money that animal spirits got rabies. And now we're seeing the Fed say, we need to put this animal out of its misery. We need, take the dog out back and shoot it. And that's what we're seeing is animal spirits are now in the process of reversing. And so you see it in the riskiest securities, right? You see it in all of those meme stocks that were so popular last year. They're absolutely collapsing. A lot of them are down 70, 80, 90%. And so risk appetites, broadly speaking, this has been going on for about a year now, where a lot of these speculative names have been, peaking and rolling over, and is just starting to now affect the major indexes.
Now, do you see this continuing? Because I know a lot of people are expecting a market crash soon with these insane valuations.
Well, a crash is one thing. I'm not counting on a crash. I do think we probably see a bear market. I think to try and bet on a crash is betting on an extremely low probability event. I do think there are still areas within the stock market that represent terrific value. And so I think it's more important probably to investors to think about, what am I exposed to? And do I really want to be exposed to those things? Because you look at the NASDAQ 100, the big tech stocks, and they're all trading at their highest, still very close to their highest valuations in history, forward PE ratio of about 30, when, the past 20 years, it's, been about 15, 18. So that's the area of the market I want to avoid, these long duration assets that have been really the subject of, or the target of these animal spirits. And I want to focus on areas of the market that represent a margin of safety, to quote Ben Graham.
And what are some of those areas that you're looking at right now?
Well, there are a handful of stocks I think that are in, a variety of sectors that have gotten, ridiculously cheap. I think where we've seen, one of the things that for me confirms my idea that a lot of these stocks are overvalued, tech stocks, is the insider selling has been bigger than anything we've ever seen. I mean, you saw, it was interesting to me to see, Bloomberg say Jeff Bezos lost $20 billion last week. Well, Jeff Bezos sold so much stock last year that if he hadn't sold that much, he would have lost even more last week. So he made his biggest sales he's ever made last year. And you see that across tech broadly, where you see insider selling was just off the charts last year. So I look for insider buying to kind of confirm my idea that stocks are cheap. And you see that in a handful of names. I think the most important sectors where that's been apparent is the traditional energy sector. Oil and gas companies have seen just a ton of insider buying. And a lot of those stocks are trading, 4 or 5 times cash flow. And so if the oil price continues to power higher, which I think it will, those stocks can't stay at 4 or 5 times cash flow. They're going to have to double, triple in price. And they've already been the best performing sector of the past year, 18 months in the stock market, but they're still vastly underowned. I mean, another segment that I think is undervalued is the precious metals mining sector. Gold and silver miners are incredibly cheap, and that's just because I think the markets have been discounting the inflation we've seen. They've been buying into the transitory narrative. That's why stocks have stayed high, gold has stayed low. But now I think markets are starting to price in the fact that maybe inflation isn't transitory. I mean, stock prices have to come down, gold prices probably have to come up, interest rates have to go up. And so I think that we're in the beginning stages of that type of a revelation on the part of the markets.
One of the reasons why we could continue to see high inflation for a while, because, energy prices do impact pretty much the price of all other goods.
Yeah, I think if you just look at, supply and demand in the energy market, oil supplies are dramatically lower than any time in the last 5 years. At the same time, demand is expected to global demand set a record this year. And so the supply and demand is very favorable for higher prices. I also look at, in the futures market, something I look at pretty closely. You look at commercial hedgers in oil futures, and typically when oil prices are going up, hedgers are selling more. They're selling, future production, locking in those prices. Today, we're seeing commercial hedgers actually reduce shorts. So to me, that tells me this is the smartest money in energy markets. That's pointing to the fact they don't think energy prices are going to come down. They're not acting as if they want to lock in today's prices, which tells me they believe prices are probably heading higher too.
Now, with inflation raging so high right now, I mean, the official numbers being 7% for December, how do people stay ahead of inflation when investing?
Well, I mean, it's a really good question. I think, Paul Tudor Jones was on CNBC recently, and he said that, real assets relative to financial assets have almost never been cheaper than they are today. And that's just astounding to me, that you have the best inflation protection in the market is on sale. And by real assets, there's 4 things I look to. It's real estate, TIPS, Treasury Inflation Protected Securities, commodities, and precious metals. My favorites of those 2 are real estate and precious metals. I mean, commodities are an effective way too, but TIPS are probably my least favorite of those vehicles, just because it's based on CPI and things. And so I think investors have yet to embrace real assets to any meaningful degree, and they remain incredibly cheap relative to financial assets, basically just stocks and bonds. And so to me, it's just ironic that we're seeing the highest inflation in 40 years, and at the same time, investors have zero interest in real assets. And it should be just the opposite. It should be, if inflation's taking off, investors should be piling into real assets. And I think that's probably where we're headed. At some point down the road, investors are going to say, I have to own commodities, I have to own precious metals, I have to own these types of things that are going to protect me from a prolonged period of inflation. Now, that doesn't mean inflation is going to stay 7.1% on headline CPI, but it does mean that I think core inflation is going to stay above this 2% level for a prolonged period of time. And if that's the case, you're going to want to make sure you own a lot of these things that protect you in that type of environment.
Now, if we look at, this has been a pretty good year so far for precious metals. Last week, we saw quite a rally. We're seeing a bit of a pullback today as we record this on Monday, January 24th. Are you bullish in the short term for both gold and silver?
Absolutely. I think, to me, I look at commodities and the gold price have generally, the oil price and the gold price have held up relatively well, considering the strength in the dollar into the end of the year last year. We had 3-4 months of really strong dollar rally, and with the relationship of oil prices and gold prices to the dollar, we probably should have seen a pretty significant decline in oil prices and gold as the dollar was rallying. To the fact that they didn't tells me that's a pretty bullish sign. And now the dollar, to me, looks like it's in the process of rolling over. It's showing some strength today as, kind of in the midst of this risk off. You see kind of a flight to dollars generally. But I think we could be close to what I would consider a counter trend or bear market rally in the stock market. Same time, dollar could roll over pretty hard. And if it does, that's going to provide a very strong tailwind to gold prices and oil prices that have, like as I mentioned, held up relatively well in the face of strong dollar. So when you look at the relationship of the dollar and inflation, it's a pretty close, relationship over longer periods of time. When inflation rises, bad for the dollar, and vice versa. We've seen inflation rise dramatically, and the dollar has rallied. That's really unusual. And that's, to me, just another sign that investors believe inflation is transitory. So when we come to this epiphany in the markets and the markets go, wait, inflation isn't transitory, you can see the dollar roll over pretty hard, which would be a very bullish catalyst for gold and oil.
You mentioned how we could see a continued downturn in the stock market, maybe not a crash, but it seems like when we do see that, investors get into the mindset of sell everything in a sense. And sometimes precious metals do take a hit at those moments. So why do you think if the stock market does continue to fall that we will see a rally in precious metals?
Because I think out of all the market environments I've studied, this one reminds me the most of the early 2000s and the dot-com bust. And if you remember back to that time, that was around the time oil prices and gold prices were both, bottoming and forming, a major low before very strong multi-year bull markets. I think that's kind of what we're seeing again today. You're seeing a risk off, and gold corrected last year for a couple of reasons. One, it got too extended above where I consider fair value is for the gold price relative to real interest rates. And so that was kind of a sign that gold price needed to cool off. Sentiment got too big, too bullish at the same time. People, got too excited about gold in the early days of the pandemic. And so it was due for a correction. But now gold is dramatically undervalued relative to real interest rates. And I'm just talking about the 30-year yield less core CPI. That relationship suggests gold prices should be much higher than they are today. So that situation has fundamentally shifted. But also, I think we're in the process of, the last 2 years, we saw, like I said, animal spirits were super stoked to chase all kinds of different, risk. And so the idea of putting money in a safe haven like gold just lost its luster. People said, why do I need to put money in gold when I can buy Bitcoin, GameStop, the ARK Innovation ETF? All these things that are just screaming higher. But when you shift from a risk on environment to risk off, I think this idea of a safe haven starts to resonate with people a little bit more. And I do think we're going to see more of, and that's why I'm kind of a little bit more reluctant to call a crash in the stock market, because I do think we're more likely to see a shift out of, just like in 2000. If you look back into 2000, 2001, if you were a value investor back then, it was a wonderful time to be buying stocks. As the NASDAQ collapsed, 70, 80, 90% eventually, you had a lot of these super cheap stocks go up 50, 100%, in a period of time. The Russell 2000 at the time was maybe the best example of this. Those small cap stocks got real cheap and did really, really well through that period. I don't think the Russell today is as cheap as it was. But there are segments of the stock market I think investors are going to rotate into as they rotate out of these unattractive areas. And as I said, those attractive areas to rotate into are commodity related, precious metals related. And I think those, just because those stocks are so undervalued, I think people are going to realize, wait a second, I need to have at least 5% of my money in gold, probably more than that, miners and things as well. And when they do that transition, I think, is much more likely than to see a crash that affects the gold price and these types of things.
Now, you were recently interviewed by Adam Taggart of Peak Prosperity, and you made a very interesting comment there that you said that the Fed must create a market correction. And I'd like to have you expand on that, and then also how Fed policy may impact gold coming forward this year.
Yeah, well, this is an idea that Julian Brigden, a friend of mine, recently brought up, saying that in order to, right now, there's a huge amount of pressure on the Fed to appear as if they're addressing inflation. They have to make some kind of strides in regards to reining in inflation. Now, inflation is probably going to peak. Headline CPI is, probably going to see a peak this year, regardless of what the Fed does, just because the year over year comparisons are going to become more difficult. But so the Fed has to, how do we measure that, what the Fed is doing? Well, it's financial conditions. You look at financial conditions. Financial conditions are the loosest they've ever been. And so the Fed has to tighten financial conditions in some respect. And so one of the major components in financial conditions is just year over year change in stock prices. So in order to appear as if they are tightening financial conditions, they need to raise interest rates and do these things. And they have to do it enough so that the stock market starts to show this tightening in financial conditions. And so I think that's, the Fed is, they're really trying to walk a fine line, right? The Fed doesn't want to create a stock market crash. They know they could potentially do that, but they know the economic ramifications are very, very painful. And so they don't want to create a crash, but at the same time, they have to try and rein in the stock market to some degree to make it look to the world as if they're still pursuing the stable prices mandate. Because doing nothing, to me, will potentially risk seeing the dollar really collapse. I mean, if the Fed doesn't do anything to address inflation and just says, hey, you know what, we have to print money because we got too much debt, that's when the dollar really rolls over hard and creates an even bigger problem for the Fed. So they have to at least appear that they're pursuing the stable prices side of the mandate. And so they're going to do whatever it takes to appear as if they're doing that, even if they're really not going to do probably enough to really break the back of inflation.
And how do you see this future policy of the Fed then impacting gold?
Well, I think what we've seen is the dollar has now priced in. You see the dollar rally that I was talking about. That's the FX markets pricing in hawkish Fed policy, saying, okay, we have to price in 4 rate hikes in 2022. We have to price in a reversal in the balance sheet. We have to price in all these things, right? Because the Fed is now using this forward guidance, they have been for a very long time, to say, this is what we're going to do over the next year. So markets, and the Fed counts on this, pricing in that forward guidance. It helps them do their job without actually having to do it. But to the extent that the dollar has now priced in 4 rate hikes, has now priced in an end of quantitative easing and potentially a reduction in the size of the balance sheet, that tells me that gold has also priced that in, right? So let's say now the Fed goes and they do end QE by March. They do start hiking, implement a rate hike in March, and they do pull off another 2-3 rate hikes. That's all been priced into the dollar. So for the dollar to go higher, for gold prices to go lower, the Fed has to now be hawkish relative to that forward guidance. What does that mean? They have to pull off 5-6 rate hikes, or a 50 basis point rate hike, which is maybe something arguably the markets have already been trying to price in, or they have to reduce the balance sheet even more dramatically than the markets have been coming to expect. I think the odds favor the Fed being able to actually reacting dovishly relative to this forward guidance, meaning they're not going to be able to reduce quantitative easing completely. They're going to have to stay in the treasury market to some degree or another, or they're not going to be able to reduce the balance sheet, or maybe they can't pull off 4 rate hikes this year. Maybe they can only pull off 2 or 3. To the extent that their actions are dovish relative to forward guidance, relative to what markets have priced in, that's going to be bullish for gold prices. Now, I think to be a gold bear, you have to think that the Fed is actually going to be more hawkish than the forward guidance that they've given, because that's what's already priced into markets.
So when it comes to how gold and silver will react, it seems like you're saying that the Fed will probably end up being more dovish than the markets are expecting, and that is going to be bullish for gold. How would you say that investors should look into investing in gold? Because there's a lot of different vehicles out there for taking advantage of a rally.
It's a great question. My favorite way to own precious metals is through the Sprott Physical Gold and Silver closed-end fund. It used to be the Central Fund of Canada. But because it's a closed-end fund, it trades at a discount or a premium to its net asset value. Currently, it's been trading at, even though gold prices have been picking up and silver prices have been picking up in the last few weeks, it still trades at about a 4% discount to the gold and silver that the fund has in storage. So here's a way. If you want to buy gold, you can go buy it at 4% below, and silver, 4% below the market price. I don't know of anywhere else really to do that. CEF is the symbol of that. And if you own enough of it, you have to own a pretty big chunk. Sprott will convert your shares to bullion. So there is really no kind of paper gold risk in owning CEF that I see. So that's my favorite way of owning the metals. I do like the miners. I think, just something like GDX. I typically stay away from the juniors, but just because of the volatility and whatnot, and the single security risk there. But GDX, I like the miners generally. I think that they are trading. Those stocks are really cheap. I mean, one I wrote about recently, Agnico Eagle, I think is the cheapest it's really ever been, at least in 10, 15 years, which is amazing to me, because here you have probably the highest quality gold miner in the world buying, Kirkland Lake, which is one of the other highest quality miners on the planet. And it trades at 4 times, enterprise value to EBITDA, that's to me, market investors betting on lower gold prices. That's the only way you get that stock that cheap. Now, if gold prices do go back over 2,000 an ounce, which I think they will probably this year, that stock is, it typically trades 10 to 15 times enterprise value to EBITDA for the last 10 years. So at 4 or 5 times, it could literally, the stock price could double and still be on the cheap end of its range of the last decade. So I really like the miners, but I think it depends on, I like to have a core position in the metals and then use miners more as like trading positions.
I think that's so key. Is it seems definitely miners are a bit more speculative than if you hold the physical metal.
Yeah, and I just from an asset allocation perspective, owning the metal itself has benefits relative to owning, equities based types of vehicles, and so I like to own both. And like I said, I use the miners more as trading, because I do think they are higher beta, more volatile than the metals itself. But when the miners get as cheap relative to the metal as they are today, I'm definitely much more focused on the miners today than the metals itself.
And do you see any risk, I guess, in the miners if the price of production increases? For example, if oil prices, as we talked about, rise and different input costs rise, do you see any risk there? Or do you think that precious metals will rise enough to make up for that?
Well, that's a really good question, because you could argue the oil price is still cheap relative to gold prices. I mean, gold prices are still very close to all-time highs relative to other commodities. They'll get a lot of other commodities indexes, and they're not. I mean, the oil price is still way well off its all-time highs. And so, it is possible that oil prices rise more rapidly than gold if we see a generally commodities bull market. But the miners are so leveraged to the gold price that gold doesn't have to go up very much for their profits to continue to go higher. I mean, gold price goes up $100 an ounce, and it means major surge in the earnings in these companies. So I don't think costs can really, for costs to go up more dramatically than profits, than revenues at these companies would mean, I think gold prices have to not resume their bull market. I just don't see that. I think if you're bullish on the metal, then the miners are really cheap relative to metals prices. So to me, that's the main thing to focus on.
All right. Well, Jesse, we really appreciate your time today. Before we let you go, where can people find you online? And did you have any last thoughts you'd like to leave with our viewers?
I run the felderreport.com. It's a blog that I started back in 2005. And for the past 7-8 years, I've been writing research reports on the site. And so we have a couple different products there for whatever type of investor you are, individual investor or more of an institutional type of trader. I put out a free blog post there. I try to do that once a week, sometimes a podcast when I have the time. And I'm pretty active on Twitter. It's just @Jesse Felder. And really what I use Twitter for is just sharing a lot of the interesting stuff that I'm reading, whether it be articles or charts or that kind of stuff. And just to leave viewers with one other thought, I think maybe the biggest mistake investors make a lot of times is not having a sell discipline. Whether it's just typical risk management and saying, I'm not willing to lose more than this, and I'm going to cut my losses there, or it's just re-examining, why did I buy this in the first place, and is my thesis still intact? There's a lot of different reasons to sell, but I find that most investors really don't use any at all. They don't have any sell discipline at all. And when you don't, the market will force you into selling. It'll take your profits away, then it'll put you into losses until you reach your pain point, and then you'll be forced to sell. So I said, my idea is rather than letting the market force you into a selling position, be proactive, have a process, whatever that is. And I think just a simple risk management process is many times the most effective for a lot of traders out there.
Once again, thank you so much, and God bless.
Thanks. Appreciate being with you. It was a pleasure.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.